Welcome to the Titans of Industry show. Today we're welcoming back one of the best gold analysts in the space, Jordan Byrne, who runs the dailygold.com and does great work over there. Since President Trump just put tariffs on importing iron and aluminum, and since inflation is beginning to become a topic again with people like Bill Gates, Paul Tudor Jones, and Ray Dalio, we brought Jordan back to speak about the topic. He has championed inflation. Jordan, how are you today?
I'm great. Thanks for having me, Lior.
Could you explain the relationship between the following three assets: precious metals, treasury yields, and the US dollar index? Gold is money, or an alternative currency not owned by or issued by any government. The US dollar is the reserve currency for all nations, and the fact that the Federal Reserve is now hiking interest rates. Can you explain the puzzle that these three things are forming?
Sure. Well, looking at treasury yields, the treasury yields usually reflect a combination of economic growth and inflation. So if you think about, and by economic growth, it's really nominal growth, so it's not real GDP growth, which is basically inflation-adjusted growth, and we always hear about that, but the long-term treasury yields are basically a function of nominal GDP growth, which has picked up a little bit since the election of Donald Trump, and inflation as well, or it can be inflation expectations. So that's how you get treasury yields, and that's why treasury yields are starting to rise, because Donald Trump's policies are going to create, at least temporarily over the next year or two, you're going to get a shot in terms of nominal GDP growth, and in addition to inflation, inflation, I mean, the inflation statistics have picked up a tiny bit, but not that much. However, inflation expectations, and that's what the market is thinking, where is inflation going to go in the near future, those have definitely ramped up quite a bit. So the market is really leading in terms of inflation statistics and where it thinks inflation is going to be. And so that explains why you have bonds rising and long-term bond yields. I mean, they have broken down. If you look at the 10-year chart, and you can go back 20, 30, 40 years and draw a trend line, you can see that that's broken out there. So that explains why treasury yields have broken out. Now, with respect to gold, gold is really a function, for the most part, of inflation, real yields, or inflation adjusted rates, or bond yields. And so where interest rates are going minus inflation. And so interest rates, even though real interest rates have actually increased a decent amount over in recent months or the last year or so, which should be negative for gold. However, as we know, the market always looks ahead. So I think the fact that gold has been fairly stable in the mid to low 1300s, and the fact that it's not trading $100 or $150 lower, I think that's because the market is looking ahead, and the market is anticipating that inflation is going to increase faster than what we're seeing, than the hikes we're seeing from the Fed. And so the market is looking out into the future and projecting that real interest rates, or real yields, are going to go down. And at the same time, in studying history, there's sometimes when real interest rates have actually been stable, or they've gone up a little bit, because the market has bid up interest rates and thinks inflation is coming. And so, in other words, if the rate of inflation is rising, or inflation expectations are rising, sometimes that can drive gold, even though the statistics might say that real interest rates are rising, which is usually negative for gold. We want to see real interest rates declining. So there's all these factors to look at. With respect to commodity prices, base metals and a lot of these specialty metals, or whatever you want to call them, I mean, they've been doing quite a bit better than gold. And I mean, that's a function of there's a lot more demand there. And we have to remember, during the terrible bear market in gold stocks and gold, other commodities actually went down even more so than gold. So a lot of these commodities were off 70, 80, 85%, whereas gold was only off 45% or so. So a lot of these other commodities had much more room to rebound when everything turned around and went the other way. Now with respect to the dollar, and finally, to end my long answer here, the dollar is it tends to be a function of real interest rates as well, but compared to the other currencies. So if real interest rates in the dollar are increasing, the dollar should rise, but you have to compare that to, okay, what are real interest rates, are real yields doing in Europe? What are they doing in Switzerland? What are they doing in Japan? So, um, again, with respect to currencies, there's so many things that you can look at, but the dollar clearly is in a new cyclical bear market. I mean, the dollar has been really weak. It's come down quite a bit. And I know we're going to get into, gold's relative performance more later in this interview, but the decline in the dollar, it hasn't really benefited gold as much as it should yet, but it's really benefited, I'd say, commodities in general, and some of the commodities like the base metals or the specialty metals that have done really well. I mean, gold has not, over the last year or so, it has not been that strong in terms of real terms. It's mostly been a dollar weakness move. So again, a lot of factors to look at here, but the trends do seem to be in motion, that we are in a new cyclical bear market for the dollar, and interest rates, I think they've put in a major low. So we're in a major new secular uptrend in interest rates, and that's going to be bullish for gold and hard assets. So it's a very exciting time to be in this sector, because I think we've made a major turn here in the last 2 years.
Jordan, you've studied inflation for a long time. Could you please explain how inflation originates? What ignites it?
What originates inflation? I mean, at the heart of that, it's really monetary inflation or deficit spending. So you have more money coming into the economy via deficit spending, via lending, via quantitative easing or very low interest rates, and a lot of that money, for the most part, it hasn't really gone into the economy, as you know. I mean, it went into the bond market with all the QE and driving interest rates down. That's one place it went. It also went into the stock market. And so we weren't getting a huge amount of inflation in the real economy, at least as far as the statistics, even though we know that underneath it all, the cost of living is really rising at 7 to 10% a year, regardless of what these statistics say. But nevertheless, the rate of even if you look at the real statistics, the rate of inflation was not rising. I mean, as it started to rise now. In recent years, it was not rising. It was kind of stable, trending lower in some cases. And so disinflation, that phenomenon where you have inflation, but you have positive inflation, but inflation is not really increasing over time, that's the best for the stock market and worse for hard assets. And so we had that for several years, and that's why money was going into the stock market, money was going into bonds, and it wasn't really going into the economy yet. But now it looks like we're finally starting to see that money move into the economy, and we're seeing a turning point where inflation expectations are picking up. And when all this money is created and you get these huge deficits, I mean, that doesn't necessarily lead to inflation right away. I mean, I like to look back. Inflation was huge in the 1970s, but if you go back into the 1960s, this is something I've looked at in recent weeks. I mean, you had a lot of monetary inflation in the 60s. You had deficit spending and the guns and butter with LBJ, the Vietnam War, the social programs. Yet inflation really didn't start to accelerate until the late 1960s and then the 1970s. So, I mean, as far as inflation in the economy, the trigger for that is always deficit spending or monetary inflation, from the Fed. And, we've seen a lot of that in recent years, but it hasn't quite triggered inflation yet. I mean, it's triggered inflation in asset prices, which we all like, but not in the economy. However, going back to what I said in the first answer, now we're seeing consumer expectations and inflation expectations. They're starting to increase just a little bit. And with interest rates breaking this major downtrend over the last 25, 35 years, people now understand that interest rates are going to be rising. Inflation is also starting to rise. And so the market is going to be expecting greater inflation in the years ahead. And all this money that has been created in recent years, and you couple that with the massive deficit spending that the Trump administration is putting forth, that is going to start to filter into the economy and really cause prices to rise. And of course, we haven't really seen it yet. I mean, the statistics, well, actually the PPI, I mean, the CPI, the Consumer Price Index, I believe recently that's about 2.1%. However, the PPI, I remember seeing a headline there where that has really increased even more than the CPI. And so that is producer prices. So you're thinking of corporations and businesses. So now their prices are really rising. And what's going to happen? They're going to have to start to pass some of those on to consumers. So with respect to inflation, just like with interest rates, we've probably made a major turn where over the next 10, 15, 20 years, we're going to see inflation trending higher. That doesn't mean it's going to rise every single year. I mean, there are going to be periods where it comes down for a year or two. However, if we're looking at the secular trend for inflation, it looks like it's really turned in recent years, and we're at the early stages of a major uptrend as far as inflation in the economy. And it's going to be very interesting to see what happens. I mean, it's going to create problems for the economy in the future, and it should be very positive for hard assets and not really positive for equities.
Right now, people are extremely cynical about precious metals companies, and certainly the junior mining sector within the mining sector itself. I remember in 2011, when the resource sector was very hot, silver was like $42 an ounce, 43, 44 the next day, and many high quality dividend stocks were very cheap. I remember selling a bit of my gold stocks positions, taking profits and buying boring companies trading really cheap like Intel or Stanley Black & Decker or 3M. Many investor friends of mine who were at the time making a lot of profits with gold stocks said that I'll regret this. Yet Intel has more than double since. Stanley Black & Decker has beaten all the major indices. 3M has been one of the best performing stocks around. Right now, though, the flip side is true. People aren't excited at all about mining. Wealth Research Group covered in 2017 a cobalt company which soared 150%, a lithium company which gained over 80%, and a uranium company which doubled. But the industrial metals, not these specialty metals, and the precious metal stocks have been lagging big time thus far. Where are we in the cycle then? Because some of the mining sector is already starting to boom, but it looks like industrials and precious metals are still falling short of the of any bull market. Have we seen the bottom yet, and where do you see us going from here?
Well, as far as junior mining as a whole, I mean, there's a lot of, as you know, there's many different subsets of junior mining, but I think junior mining as a whole made a major bottom there at the end of 2015 or early 2016 with commodity prices. And as we were talking about before, I know there's some specialty metals, some of the energy metals. I mean, those juniors have just performed fantastically. With respect to gold and silver, because that's what I really follow the most, I mean, they've been consolidating. They've been correcting and consolidating for quite a while. I mean, we're almost, we're about 18 or 19 months into that correction and consolidation, which began around the middle to the end of the summer of 2016. And I think we're coming close to the end of this correction and consolidation. We may not be there yet. We may see a little bit more weakness over the next few months. However, I think at some point this year, we are going to see junior mining, at least those that focus on gold and silver, put in a secondary major low and trend higher and have that trend continue. What I mean trend higher, I mean trend higher in an impulsive action where you see the market make new highs and then higher highs. So I expect that type of move to start at some point this year, maybe around the middle of the year or some point in the second half of the year, and then into 2019. And base metals juniors and other juniors should probably follow, or perhaps even lead. I don't know which is going to happen first, but with respect to gold and silver, because that's what I focus on, I'm very optimistic over the next 12 to 18 months. But as far as when is the next big move going to begin, it's anyone's guess. But I think it, again, coming back to what I said, I think it could be in the second half of this year or around the middle of the year. That's something I'm looking at. So not quite yet, but we're almost there. I mean, I think listeners still have a couple months or so where they can buy high quality companies on the cheap, because as you know, when the sector starts moving, I mean, these juniors can move very fast. And then if you're trying to get into something, you're chasing it higher, and because if you don't buy it now and you wait for it to go up and chase it at higher prices, you're not going to make as much money on the move up. You want to buy when things are cheap. And so that's what I'm hoping to do over the next couple months.
I know you're very big on ratios and analysis of overvalued and undervalued when you compare gold or gold shares to other sectors. How cheap is the gold sector compared with equities, historically speaking?
Well, that's a great question. Looking at based on my research, the cheapest that precious metals and precious metals equity, well, let me start with the equities. The cheapest that the gold stocks ever was basically at that early January 2016 low. At that point in time, gold stocks relative to gold and relative to the stock market were basically at the lowest levels in 90 plus years. I mean, you have to go back and look at data from the 1920s, and it's kind of difficult. So gold stocks relative to the stock market and relative to gold were basically not even cheap. They were just historically cheap. I mean, we're talking about at nearly a century as far as the lows there. And where we are here and now, I mean, they're not quite as cheap, but it looks like these ratios with respect to gold stocks against gold and gold stocks to the stock market, it looks like they're probably going to make a higher low at some point this year. But when you're looking at like a 50 or 100-year chart, it will be a significant low this year, but it's not as low as where they were 2 years ago. So we're not as cheap as we were at that point, but nevertheless, the precious metals sector is still extremely cheap, and especially the stocks. I mean, the sector I can't get over how cheap it is. I mean, yes, we've moved up in the last couple of years, but as I just noted, we've been consolidating and correcting for a good 18 months. So that has created some new values. Again, we're not quite at the levels we were 2 years ago, but we're not that far away from those levels. So it's kind of giving people what I think could happen this year and over the next several months. It's really your last chance to get in as far as a second historic buying opportunity. I mean, the obvious first one was there in late 15 and early 2016. But again, over the next 3, 4, 5 months or so, I think investors could have a second and really last chance to buy this sector really cheap, because when gold eventually does make this breakout through 1375 to 1400 and it runs to 1550 an ounce and higher, the mining companies and the juniors, they're going to rise. They're not just going to double, they're going to triple, quadruple, rise fivefold. You're going to see those types of moves, and then the sector won't be cheap anymore. So you have to, I mean, the value is there, it's cheap, and to be able to capitalize on it, you have to be able to buy the sector before gold breaks out.
How cheap is gold compared with foreign currencies?
Well, gold compared to foreign currencies, it's actually been trending. It's been trending higher. I don't want to say it's been in a weak uptrend, but it's kind of been trending higher since the end of 2013. What concerns me about gold against foreign currencies, at least in the very short term, is over the last year or so, gold has mostly been driven by dollar weakness. So the gold price against the euro, against the yen, against the Swiss franc, against the British pound, if you're looking at all those in an index, the gold price relative to foreign currencies has not been that strong. It's really gone sideways over the last 12, 13, 14 months since that December 2016 low. Whereas gold, since that point, gold has rallied from the 1120s up to the mid 1300s. Whereas at that, during that period, gold against foreign currencies has not trended higher by that large of a degree. And looking at gold against foreign currencies and also gold against equities, they're coming up against some trend line resistance. And I think that we need to see those charts in favor of gold break out to the upside. We need to see that happen if gold in dollar terms is going to make this major breakout. So as far as gold against foreign currencies, I wouldn't say it's cheap or expensive right now, but again, over the last year, it's kind of underperformed a little bit. And so what we want to see from gold is we want to see gold strength in real terms. We want to see it outperforming these other markets and asset classes. Because if it doesn't do that, then the move in gold, at least as far as the last year, it really hasn't been a bull move. It's really just been a dollar weakness move, and that's why gold has been unable to break out yet, because it hasn't showed strength in real terms. And so that's something I'm looking at. I'm analyzing carefully. I'm waiting for it to happen. So when gold can break out against these foreign currencies and stocks and other asset classes, that will signal that it's about to begin a real bull market move, because over the last year it's just mostly been rising because of the weak dollar. And I mean, that's fine, there's nothing wrong with that, but every time gold has had a major move higher, it hasn't just been dollar weakness, it's been strengthening against bonds, stocks, foreign currencies. So we need to see, I'm waiting for that to happen. I mean, I think it will at some point this year. But until that happens, I think gold is probably not going to break out just yet.
When gold outperforms the four major foreign currencies, like the euro, the yen, the pound, the Swiss francs, it has impressive performance for months on end. Let's talk about one of the things that all Americans are seeing right now, but no one is admitting. Wages are rising, coupled with tax cuts. This is the one thing we haven't seen in America for 3 decades or even more. People think that the commodities are the main reason for price inflation, but in a $1.50 loaf of bread, there's only about 7 cents worth of wheat. So if the wheat doubles, that doesn't change much the loaf of bread. But if the baker, the truck driver, the packagers, the people in charge of anything that has to do with the supply chain, when they get a bump in wages, that's truly trickling to the bottom line. What's the impact of this on the inflationary pressures and expectations going forward?
Well, I think the fact that we're finally starting to see wage growth is probably playing into the reason why the market is pricing in higher inflation down the road and why inflation expectations are rising. And so that's a case of where inflation expectations right now are rising faster than inflation, because the market is seeing these wage increases and is then making the connection that this is probably going to feed into higher inflation in the future. So wage increases are very important. I mean, I wouldn't say they're the underlying cause of inflation, because we already talked about that inflation is really a monetary phenomenon. It's just a question of, after you get the monetary inflation and deficit spending, how long does it take for that to eventually wind up in the economy? And wage growth is certainly has a role as far as that entire relationship from when the excess money is created to eventually when it gets into the economy and prices rise. I mean, wage growth is probably towards the end of that chain, but it's definitely a very significant thing, and it's feeding into the market expectations for higher inflation in the future. And it's interesting to me, just on a side note, how, I mean, wage increases are a good thing. It's good that people are making more money. I mean, there's a lot more poverty in the country, unfortunately. I mean, the middle class has been eroding. And it's great that we're finally seeing wage increases, but it's just funny how economists and all these people talk about it like it's such a big problem. Because I mean, it kind of is, because eventually it can feed into inflation. But I just think it's good for the country. It's good for workers that they're finally seeing some wage increases. But the problem is, I think that's going to eventually lead into higher inflation down the line.
Lastly, Jordan, the infrastructure program and the tax cuts. Everybody loves less taxes. Obviously, everybody likes when the government goes ahead and improves rotten roads or out-of-date bridges or faltering sewer systems, which have been neglected for decades. But no one is willing to truly pay the price for these programs because we are seeing no budget cuts, no reductions to the deficit. It's growing. It's going to be a record deficit. Is America on the path to fiscal disaster?
Well, I think the tax cuts are giving the economy a jolt, and will probably, the question is, how long is that going to last? I think that jolt can probably last into at least early 2019. However, I did see, I think it was Morgan Stanley who said that only 13% of the savings from the tax cuts are going to employees or workers, basically, or wages. So most of the corporations are just using most of this money to buy back stock and pay bigger bonuses. And, buying back stock, we've seen a lot of that already. That's great for shareholders. It's great for executives. But, the majority of these people they've already done extremely well in recent years. And, they're going to be helped in a big way by these tax cuts. Whereas the average person, the average worker, they're getting some breadcrumbs here and there, but lower taxes are a great thing. And obviously, when you cut taxes, the rich people and the upper middle class and the super rich, they pay the most taxes. So anytime you cut taxes, they're always going to get the biggest tax savings. But the fact that a company is saving so much money from these tax cuts, but only 13% are going to go to wages and employees, and then most of the money they're just buying back stock and giving it to executive compensation. That's what we've already seen that happen in the last 15 years. It's just a continuation of that, where the rich are benefiting the most, the super rich are benefiting the most, and the average person, the average employee, they're just getting a few breadcrumbs. It's kind of trickle down economics on steroids. So I don't think it's ultimately going to have that much of a positive effect on the economy beyond, early to the middle of 2019. Like I said, it's kind of given the economy a jolt, but I think that jolt is going to fizzle out at some point next year and the year after that. With respect to infrastructure spending, the economy is going to be running, or the Trump government is going to be running the biggest deficits that we've ever seen in peacetime, basically, peacetime during an expansion. So we're still in an expansion, yet we're going to be seeing these gigantic deficits. And so I'm not sure that, even though the country really needs infrastructure spending, because, roads and bridges are falling apart, our airports are just crap compared to the rest of the world. Most of them are just garbage. So even though we're running these huge deficits, I really would like to see infrastructure spending. I think it will happen, but I'm not sure if Congress is going to have the appetite for infrastructure spending, given that we got the tax cuts through and now we have these massive deficits during a peacetime expansion. I think we have to see, perhaps the economy run into more problems, perhaps go into another recession. I think we need to see some of those types of things happen before Congress has the appetite to really push through infrastructure spending. So I think the infrastructure spending could potentially be, I don't want to say a cure, but perhaps an antidote to the next round of economic weakness. But I don't know. I could be wrong, and maybe Congress will push it through before we get to another recession. But I'm just a little skeptical of that. I don't see that happening. Until probably the economy gets into the next recession or encounters some type of major shock. I would be really surprised if Congress wanted to push through infrastructure spending, given that deficits are now ballooning again, and we're not even in a recession yet, and deficits are ballooning. So it's pretty scary to think what could happen to the deficits if we fall into a recession over the next year or two.
Jordan, where can people follow your work at the Daily Gold?
Sure. On the Daily Gold, I post a lot of free information. I usually write an article once a week. It gets posted there. Interviews like these, I post there. I have a free newsletter that you can sign up for, and I do an update every weekend in the free newsletter, and I usually I share some snippets from my premium updates. My premium newsletter, you can find more info about that at thedailygold.com/premium, where essentially I focus on market timing with respect to gold and silver. And in addition to that, it's focusing on the fundamentals of juniors and picking the companies out there that I think have potential to rise, 3-5 times your money and maybe even 10 times your money. Those are the companies I'm really looking at. I'm hoping I can find those while gold makes this big move. Gold and silver make this big move higher over the next several years. And so yeah, that's what you can find at thedailygold.com. And I have a YouTube channel, which is thedailygold.com/YouTube. And you can also find me on Twitter at thedailygold, THE Daily Gold.
Joe and Roy Byrne, thank you very much for taking the time today.
Thanks so much for having me.